What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Jack, and is it Krupey? Is it Krupey or
Krupey.
Krupey?
Krupey.
All right, Krupey like Groupie. Okay, cool, awesome. And how you
Yeah,
doing today, Jack?
I'm doing great. Thanks for having me.
Oh, it's my pleasure. And I got some great news for you, Jack. Today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, buyers, sellers, syndicators, operators, developers, all that kind of stuff. And you may be thinking, why would you do that? And the answer is if you've ever heard of the private, the off market deals that you're not supposed to discuss publicly, they're also known as 506B syndication, then you should know that the SEC requires that you have a documented prior substantive relationship, or else they'll get ants in their pants. And we definitely don't want that. So I have people on here to talk about how they fit into the deals. And the important thing for you is that you will learn how to effectively communicate on the subject of commercial real estate deals and understand what the parts of the team look like. But before we get too deep into real estate, Jack, do you want to say a thing or two about yourself?
Sure. So I've been in real estate over 20 years, started with the more traditional fix and flip, single family, small multifamily landlording. 2008 had a crazy opportunity. Wall Street hedge funds needed real estate people because they were buying the non-performing mortgages. So I made a pivot, moved back to New York City, and kind of grew through Wall Street, ended up buying $3 billion of distressed non-performing loans. Loved it for a while, but it kind of turned into corporate hell for me. And I'd been personally investing in syndications just passively for a number of years. And when I was fortunate to get bought out of my Wall Street company, was already investing in syndications and decided to build my own fund around my personal investing. So we have two funds we run. One is a diversified fund where we raise capital, and one investment is in multiple syndications or multifamily, self-storage, mobile home, and then we also have opportunities to invest deal by deal. So that's what we do now in a nutshell, and we've made over 40 different investments through our series of funds into properties all over the Southeast Sun Belt and a smattering of Midwest if there was interesting opportunities there.
Awesome, awesome. I love that answer. Now, the first segment that we have here, it's the five distinct motivations. But before that, I gotta say, but wait, check your eight. And Jack, I don't know if you can do this, but maybe you can see through the camera into the user's device. And down there, there might be this subscribe button, and maybe they haven't, hit that yet. Oh, okay, it's a dumb joke, but I do it in every episode anyway. The five distinct motivations. Now that I've spoken to literally hundreds of different people in commercial real estate, I know that everybody has their own unique why for why they're involved here, but I found they fit pretty neatly into these five different categories. And when you're in real estate, you need to know what people's motivations are, just because these deals take months to close, they take years to go full cycle. And so you need to know what's going to keep you from throwing in the towel if the going gets tough. And here we go. The first one is preservation of purchasing power. What's that? Well, some people, they're work optional. They don't have to hold a job of any sort because they've got a portfolio of assets, and the way that they pay their bills is from the proceeds of ownership. And if you're in that situation, it might be a little bit hard to understand why you go through the hassle of another acquisition, but there's two scenarios off the top of my head, at least, on why somebody would be motivated to do it when they're in this situation. One is if inflation is rearing its ugly head, that's going to eat away from the purchasing power of your cash flow. So it's going to be time for another acquisition. But the other one is if there's an asset market crash, or basically you're aware of a sweet deal with a ton of distress, that's when you're going to be able to scoop up the property at a steep discount, and that will be enough motivation. Now, that is not where I'm at yet in my real estate journey. Closer to where I'm at and why I have the podcast and all this kind of fun stuff is because I got a background in technology, which is, of course, a high income, high wage, high salary earner position. But the way that I got attracted to a real estate was from the CRM industry. And in 2014, I started doing the online funnels and all that kind of stuff for a guy who was doing 10 single family transactions per month. So flipping about 10 houses a month for years before he hired me. And he was making money hand over fist compared to me. And I noticed my tax burden and I was like, you know what? I need to figure out how to pivot where I'm getting rewarded for my effort in the form of deployed capital, aka equity. And that's what I'm up to. Now, that's a little bit abstract, especially for youngsters. They're not really thinking that way. A more frequent motivation for them is they want to take control of their schedule, or maybe they want to hustle like crazy now so that they can retire early. That makes sense. But maybe they just want to work fewer months per year or fewer weeks per month, something like that. And to be brutally honest, a lot of the people who want to fast track their retirement, they think that that's secretly everybody's motivation, but they're just in various levels of hiding it. And I assure you that is simply not the case. There are some people, like the ambitious types, who they just want to buy their entire hometown. They're in it for that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And so that's why they're going to keep on hustling. And I know that in some circles they vilify people like this, but at the end of the day, you need people on your team who are not going to just throw in the towel when things get tough. And this ambition is what's going to keep them going. So they're great members of the team. Just like the last group, but instead of being their own generational wealth that they're focusing on, some people have picked a sector of society. Maybe it's the environment, maybe it's animals, who knows what it is, but they want to make a big impact. And that's only going to happen if you have a very significant financial backing. And that's why some people are making these commercial acquisitions, is to give them the freedom to make that sort of choice. So Jack, those 5 different motivations, what combination of those would you say describes you best?
Definitely the trading time for money, and the retiring, but not necessarily retiring. It's just having the freedom, to do that. And inflation's also, a big part of it too. Now that I did have a windfall when I did sell out. So, I do have a reasonable net worth that, and I'm of the belief that inflation is going to be the lesser of two evils and that we're likely to see continued inflation. And in fact, we met at an event last week, and one of the keynote presentations was that this is not a cyclical issue of inflation right now. You have baby boomers retiring, you have a chronic shortage of labor, and we also have what'll likely be continually high oil prices just because there's not as much oil development. The trends of the world are to kind of clean energy, but the fact is there's not enough lithium, there's not enough of the rare earths to really move the needle on that, I think, for at least a generation. So, but the number one, if there's one, it was the freedom. I don't want to, didn't want to retire, but I definitely wanted control of my time and work when I want to work, travel, have the flexibility. That was, a key motivation for me throughout my entire life.
Mm-hmm. I love that answer. And of course, discussing these different motivations, there's a little bit of an issue, which is that you might come off as being naive or overly optimistic because, after all, it's business and every business has risks involved. And if you've ever been involved in a 506B deal, whoever the securities attorney in the mix, they should have forced everybody to fill out this really invasive questionnaire, this financial questionnaire, sometimes called a suitability questionnaire. And if there was no securities attorney involved in your deal, then you should be running away. You shouldn't just be walking. It's very, very bad. It turns it into a house of cards. But as I was going through those questionnaires, I was thinking of the value that each question was asking. And the tolerance for risk assessment, I thought it didn't have much utility. So I've got my own version to find out about risk and the perception of risk, and it's a fill in the blanks question. So Jack, there are many popular investment asset classes, but I think blank is too risky. So it can be inside real estate, it can be outside real estate. What's too risky for you?
Yeah, for me, I'd say, offshore type investments in jurisdictions that I just don't understand. At least in the U.S., there's rule of law, although in some markets the evictions maybe are not being followed to the rule of law. But yeah, for me, I've gotten pitched some interesting random things in just foreign countries, some of which are still first world countries, and some of which were just like so off the beaten path as like I'm not even considering this. So that's where I draw the line right now. U.S. real estate through a private placement. I mean, I think it's all the business plan and the sponsor and just doing your due diligence. And there's nothing off the table. I've done a lot outside of real estate. I invest in some pre-IPO bridge loans with some ex-Wall Street guys down here that I know in Puerto Rico. Done the ATM machines, done private equity, venture capital, you name it. In my personal portfolio, I've been a lot of unique stuff because I do think that these alternative assets are generally outperforming the stock market.
I absolutely love that answer. I lived in Taiwan for 15 years, so I know the immigration part of even like land ownership, like that can be some serious hurdles. So you're also depending very strongly on whoever the local connection is. So yeah, I am so there with you when it comes to international. But of course, there's the other side of business, which is the math, the numbers and all that kind of stuff. And to be brutally honest, when I first started doing these chance encounter interviews, I avoided asking about these deal metrics that my guests really hone in on. And that's because some people in this industry, they're more like a public relations role or a marketing role. And so they're not going to be really up to their eyeballs in spreadsheets. And the underwriters themselves, the actual spreadsheet junkies, they're going to look at every single number and make sure that it all jives out. So they may have more trouble saying, oh, well, these are the numbers that I go off of. But it's important, and everybody will have some sort of numbers that they look at first. And for anybody in the audience who's only listening and not watching, I'm going to read out the options that I have here. It's not an exhaustive list. There are a few others that some people have already mentioned, but here we go. Cash on cash, IRR, cost per door, net operating income or NOI, the going in cap rate, which is actually the difference between what the going rate in that area is as far as cap rates versus what you're actually paying. Then there's the loan interest rate, which is especially important if you're going to be assuming it. The occupancy rate, which is the inverse of the vacancy rate. They're the same thing, just inverse. The average income where the property is located, the amortization period of the loan, especially if you're going to be assuming a loan, the difference between the market versus the in-place rents, the population growth where the area is located, so you have some baked in appreciation forces there. The sponsorship record, which is how many deals have gone full cycle, how many are on the go right now. The waterfall split or exit strategy, which tells you what happens after your capital is returned to you. And I also have DSCR, which is debt service coverage ratio, which means how much of the revenue from rents is going straight to the loan and has no chance to get to investors and whatnot. So Jack, feel free to add any others that you're really focusing on, but what are your big metrics that you zoom in on?
I mean, I think those pretty much cover it. I mean, we certainly focus on the comps, both market rent, in-place rents. Do we believe it? Because that's something you have control over. So we want to hone in on that, because you never know what the cap rates will be in 3 years, what interest rates will be in 3 years. But we want to look at the business plan, certainly sponsor track record. But as far as like current, the questions that I'm going to play devil's advocate and ask a sponsor about is, all right, show me the market rents for a classic unit. Show me which comp, making sure that comp is a real comp and not on the other side of the tracks in a much nicer neighborhood. And then currently, in today's market, it's like, what's the debt structure? Is it fixed rate debt? Is it still bridge with an interest rate cap? And a couple of years ago, it was a dangerous time to be in with bridge, but bridge with a cap now may not be as dangerous. I do think rates have peaked, and as long as there's a cap in place for 3 years, and if the numbers work, the numbers work. But certainly like a deal that still pencils, it has a lower loan to value, can still hit those return metrics is certainly intriguing.
I love that answer.
I forgot one. I'm sorry. Like the depreciation. So if there's already a cost seg and you have an idea of the kind of percent per dollar for depreciation, we have a lot of my investors are what I'd call tired landlords, and have a lot of property they already own, maybe that's fully depreciated, and investing in something new can give significant tax savings.
Great answer. I love that. I'm eating it up like a delicious subscribe sandwich. Is that intense or what? It's always, that thing always kills me. But it's the way that I remember. It's time to bring out the Dan Does Deals commercial core competency cube with the 6 different roles in a commercial real estate deal. And the whole purpose of why I go through this every single episode of Chance Encounters is because this way you will learn how to more effectively discuss the teams that are involved in commercial real estate deals. If you are going to pursue a career or an investment strategy that includes this stuff, I really do think it hinges on your ability to communicate effectively, and that's why I go through it. And if you're looking at the die, this cube here, and going, wow, I really need me one of those, the good news is it's completely free. You go to dandoesdeals.com. There's this big prominent button. You can click on it and download and print out your own cube and assemble it yourself. The kids, I'm sure, will get a kick out of that. But I made one, it's basically the cardinal sin of marketing, this one error that I did, which is I don't ask for any contact information in return for my freebie. Never do that, okay? But I'm doing that because I want to make sure that there's nothing stopping you from getting your own copy and practicing this stuff, because I really think it's going to make a difference. So let's go through the different sides right here. So the first one I'm going to talk about is who the repositioner is. The repositioner is probably the most visible people of the bunch, and that is because they are the acquisitions people. They're finding the deals, which means they're looking at probably hundreds of deals before they find one. They're doing a bunch of paperwork. They're underwriting the deal. They're figuring out, first of all, is the seller slash broker even telling the truth about how much the property is making? Because okay, but the repositioner, their real job, the reason why they're doing the math and all that is to find some upside. They're figuring out how can they make it more profitable than it is right now. And the most peculiar side of being a repositioner is you have to have a vast network of financiers, who are, of course, people who will lend money to your business, the different investors and whatnot, the people who are not dealing with residents or anything like that. They have no GP roles. They are just dealing with paper and money and the owners of the building. And the reason why the repositioners have to have this vast network of financiers is because if they can secure a more advantageous loan, that goes straight to the profitability of the building. So that's what they're up to right there. But the repositioner's next more conventional place to find more upside is to take a look at the operations and stop those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rent and mowing lawns and shoveling snow if you're where I live. The things that I can contribute to GP teams, and I have in the past, is between the web-based assets and the automations. That's one piece of the puzzle. But if you really understand that the enemy in this business is vacancy, then even if you're like me and focusing on bigger properties, 100 units or more, if you're outsourcing your property management, somebody on the GP team still has to have serious marketing chops to fill those units if they're not able to pull that off. So those are the ways that I can contribute. But of course, there's only so much you can do with operations. So the next typical place a repositioner looks is to get a contractor team involved to do a value add, to upgrade the property, make it a nicer place so that the next residents will be happy to pay more in rent than the previous ones. But if only it were that simple. You can spend an endless amount of money on contractors. You could go ahead and gold plate the toilets if that's what you really want to do, but you're not going to get a good return on investment. And then of course, there's also the other dangers of them dragging their heels, not staying on schedule, using subpar materials and that sort of thing. So if you're like me, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because you can be certain that that's not going to be me. I'd still be stuck at an airport in an hour or two, so I really need to depend on somebody else who's nearby. But let's do a hypothetical. I've mentioned these different roles here, and let's say you become a repositioner. You're starting to do your own deals. Maybe you're an engineer or a physician or an attorney, something like that, and you think to yourself, well, I know how to buy a house. I just put down my down payment and I borrow the rest. I bet if I pooled my resources in my circle of friends, we put in like 100K each or something, I bet we could buy that 350 unit apartment complex that's down the road. So when you turn around with your group of friends and turn around to the financiers, the banks, and say, hey, I want to buy that 350 unit apartment complex. It's tens of millions of dollars and 350 units. You got, I don't know, say tens of millions of dollars you want to lend us? Well, there's a problem with that little plan so far. And if you're in a mentorship program or you have a guru or something like that, I encourage you to listen very carefully to this next part, which is the Achilles heel in it. The financier is going to say, who's your sponsor? Who's your KP, your key principal? And that is a person who already owns a similar asset. So if you want a commercial loan for a 350 unit apartment complex, somebody in the fold is going to have to already own a 350 unit apartment complex, because that proves to the bank that you're not just going to run it into the ground. Now, on top of that, among the GP team, you need a certain amount of liquidity. You also need a balance sheet. In other words, the collateral that's equal or greater than the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Jack, I know that you check a bunch of those different boxes after doing this for that long. And of course, everybody has some financier relations. But what pieces of the puzzle are you most likely to contribute on your next deal?
So we're definitely part of the financier. We're raising capital, and sometimes we'll use the term fund of funds or fund of syndications, because we do have one fund that's purposely providing diversification into multiple deals. So, if you're that passive investor, doctor, lawyer, tired landlord that's wants to put 100,000 in, and you don't want to be in one deal with all the risk assigned, we can solve that problem by giving you access to multiple deals. And we're also moving towards the key principal, potentially signing on loans, providing signing on loan documents, providing some liquidity, and and being literally a value add partner or a co-GP on the deal. We don't look to have control, because generally we're not bringing a majority of the money. But we have experience. We're in 40 plus deals. We're getting, especially now when certain deals are challenged, we're getting a lot of market insight on what other sponsors are getting for loan modifications for certain problem deals too. So we do bring a lot to the table, in addition to just capital. Because again, just to be compliant with with all the SEC rules, we're not being compensated for what we raise. We're raising money and generally negotiating better terms. We're either a piece of the GP, which in some cases will actually give our investors a better deal as well, or we're just raising LP money, but we're an active participant in the GP, generally not asking for control, but just being part of the team, and just being a good partner, and adding value wherever we can.
I love it. I love it. So there's the roles. Now let's talk about the buy box, the deals themselves. So when real estate people are asking, what's your buy box? What's an ideal property? They mean what's easier to say yes to and more difficult to say no to. And we're really asking about three main things. The first one's geography. Where is it? Which state, which county, possibly even which neighborhood. It's absolutely going to matter. And the second one's going to be size. And the reason why size is important is because you have a different type of group that takes over the smaller properties from the bigger ones, like a 10 unit apartment complex compared to 150. But as you can tell, in multifamily, the way you define size is by the count of the apartment units. And in other forms of real estate, it goes off of acreage or square footage as well. But that size is going to matter for the reason I mentioned. Now, the third one is usually called class. I'm not a fan of using the term class, because I think they really mean desirability. And more importantly, they lump two completely different categories together when they call it class, and those are condition and area. So when you're talking about the condition, it's how old is the building? How beat up is the building? What sort of luxuries and amenities do they have that really contribute to the desirability, right? That's the condition. But if you're talking about the area, especially if you're talking about multifamily, because it's a form of residential, with them, the peculiar part is the school districts are going to be very important, and you need to know about that. But every type of real estate, you have to know about the crime rate. But then there's also that broker trope that you always hear, which is location, location, location. I'm not a fan of that saying, because I don't think it's very informative. What I think it means is traffic, traffic, traffic. If you've got a gazillion people passing that property every single day, it's going to be more desirable than one where it's all crickets. But both the area and the condition, both of those ratings of desirability, they're rated the same way as in grade school. So you have A plus at the top, then it's A, then it's A minus, then B plus, and so on. So Jack, for you and your crew, like, I also get that it's a fun model, but for the deals themselves, what's easier to say yes to?
Yeah, I mean, we definitely play in that B. Perfect scenario in the world is like a B minus asset in an A area. that has been owned by a long-term owner that just hasn't really been aggressive with raising rents, where the property's stable and nice, but the owner's just asleep at the wheel, or frankly has owned it so long, has a low basis, doesn't need to rock the boat, and where there's plenty of room to do value add. That's our ideal scenario. We try to avoid the true C minus, high crime areas. Just historically in real estate, even in my 20s, the times I got into trouble, so when I got greedy and tried to chase what looked like high returns on numbers, but happened to, it's you can't, 20 cap rate is great, but if you can't collect rent because you're evicting people every week, you don't really ever get there. So, that's our bread and butter. We also, we're doing a marina RV park deal right now that has a much higher entry cap. And, I think it's kind of like the way self-storage and mobile homes were 10, 15 years ago. It's largely a mom and pop industry, niche industry, higher returns. We like light industrial. I think it's good for the reshoring that's happening in America. Some mobile homes and storage are still, pretty popular classes that we'll certainly look at, but I'd say a bulk, we're still at least 50-60% of what we do is still that classic multifamily value add. And then the last component right now is if there's some distress, and it could be property distress, or it could just be financing distress because of the bridge loan. So a high quality property where the only thing wrong with it is the current ownership's being squeezed by interest rates, is intriguing for us, because that could be a good opportunity to get a great asset at a good price.
I love it. And which states do you focus on, or geography in general?
Yeah, so generally the Southeast and Sun Belt, we follow the sponsors. So most of our sponsors have 2 or 3 markets that they're following, and they tend to be in the Southeast and Sun Belt. But we're also in a smattering of deals. I mean, we're in a deal in Indianapolis, a deal in Dayton, Ohio. But I think that the growth markets, the Southeast and Sun Belt, are key. And for us, the sponsors first. And I love where we are in the scheme of things, because it can take a long time and a lot of money to chase deals. Most of our sponsors are looking at 200 plus deals to find one deal that makes sense to buy. And so they're looking at, we have 20 sponsors all looking at 200 deals. Each of them maybe brings us 2 or 3 deals a year. So we're getting, call it 60 high quality, highly vetted deals that are the 60 out of 20, 10,000, 20,000 deals. And we might do 12 of them. Mm-hmm. So I like that the deals are being highly vetted even before they get to us. And then we have our pick of the cream of the crop.
Mm-hmm. I love that. I love that. So then let's talk about people. My favorite part about commercial real estate is because it's impossible to do all of the roles in a commercial real estate for any meaningful amount of time. People hunker down on their strong suits, 1 or 2 or more roles, but because we're constantly trying to put these teams together, give these introductions and referrals, it makes for a really wonderful environment in general. But at the same time, because we have our own unique skill sets, there are some people where we're better suited to help than others. Me personally, with my marketing and content and tech and all this kind of ridiculousness, the sponsors and KPs are people who I'm always eager to speak to. They've already got some portfolio put together, and I can make a big difference when that's the case. Whereas when you're just starting as a local or a repositioner, you need grunts who can be on the phone for 80 to 120 hours a week. And that's not really where I'm making the biggest difference for people. So I'm eager to speak to the sponsors. And then, of course, at the end of the day, we are in the industry of capital deployment. So I'm also very eager to speak to different financiers. But Jack, you have a fund, so I imagine the financiers is a big part of who's in the audience that you're looking for. But who are you best suited to help?
Yeah, I mean, it's really, we do play both sides of it. I think in today's market, our number one is definitely to find investors looking to invest outside the traditional stocks and bonds market in real estate. I came from a Wall Street background. I've also came from a landlord background. So high earning W-2 professionals. I mentioned before, tired landlords. I think the number one area would be, if you're a landlord that's tired of doing it yourself, you've got a substantial portfolio and you want to start slowing down, we're uniquely equipped to help structure deals, potentially help you coordinate a 1031 with a network of our vendors where you could sell a few of your smaller properties and 1031 into a larger syndication with a professional operating team that can save you significantly on your taxes, get you into a more passive investment, and potentially even improve your cash flow without paying taxes on it. So that's a unique thing that, just based on our sophistication and my prior background, we could help investors with. And we also have deals that have a lot of depreciation. So anyone who's a landlord who's collecting a lot of rents on their Schedule E, investing in one of our deals can save you on your taxes currently. And for those high W-2 people, occasionally we've helped them structure some things as well. I have a friend who's a very high earning attorney, and his wife is mostly stay at home with the kids, but does help with the business a bit, and not too far off from potentially using real estate professional status. And if one spouse is a real estate professional, it doesn't matter if the other spouse earns $2 million, $5 million a year. You could potentially take your income and invest in syndications and drop your ordinary income. So I love the tax loopholes. I did move to Puerto Rico partly for the weather, but also there's some tax advantages here. And I love to just nerd out and try to work together with our investors to see if we can help. And then on the sponsor side, we're always looking for new opportunities to vet sponsors. So right now there's certainly more deal flow than money, but we're always looking for opportunities. So I want sponsors and potential passive investors both to reach out.
Perfect. And so people must be thinking, how on earth do I reach out? And of course, I'm going to sandbag that for a second by saying how to reach out to me. Fortunately, I got this really distinct last name, makes it super easy to find me, especially on LinkedIn, which is the platform where I spend most of my social media time. And you can see I've got a few books that are available on Amazon.com and business related skill sets and whatnot. But if you are an investor, a syndicator, or anything like that, based on my CRM experience, I find that there are some big issues with how people document their substantive relationships. So if you scan this QR code right here, you can pause the video if you need to. That goes to the FAQs page of 506BME, which is the platform where I offer that IT service. The idea being, if your laptop falls into the bathtub and then you lose your documentation and you get audited by the SEC, it's a huge problem. It turns your entire business into a house of cards. So that's what I offer for people who are interested in that. But Jack, if people want to reach out to you, so social media, email, phone, website, how should people reach out?
Yeah, absolutely. Our website is JCAM Investments. That's JKAM for JK Asset Management, jcaminvestments.com. We're also on all social media, both the company name, and then I have a pretty big presence personally on LinkedIn, Facebook, Instagram under my own name, Jack Krupey. So reach out on your platform of choice. We've got a number of informational products, guides and stuff that we give away for free as well. So a lot of content. Really appreciate the content you put out. We try to do the same. And as I said, I'm an open book. We love to have conversations with investors, and a rising tide raises all ships. So it's great to even though we're both in adjacent parts of the business, we can certainly help each other. And I hope we provided a lot of value to the audience.
Absolutely. And when it comes to information that's available out there, one thing that's not available is the public service announcement that I have to share. It's not for you, Jack. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that you can see down there. You can get rid of it for free. You just click on it. Full disclosure, I like it when people click on it, because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so we're clear, as I said, there's no cost involved. It does, however, mean that my videos may show up on your list of suggestions. But frankly, you can go ahead and ignore those suggestions, because I really appreciate the fact that you spent this time with me. Just like Jack, I appreciate you joining me today. It's been great.
Absolutely. Thanks for having me.
Awesome. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.